move into influencers, guys. Okay. For influencers, we specifically chose to look at some of the harder ones. Honestly, I think most of the finance influencers are pretty hard. I think they're the hardest influencers out of all the topics. But can we actually talk about this in the chat? Can we actually talk about this in the chat? Is influencers just not underrated in isn't don't you think influencers is a bit underrated in terms of how hard it is across all the topics? Like I feel like even in marketing and HR, influencers is where it gets heavy, but like I feel like the marketing strategies are easier than the marketing influencers. And same for HR. I think marketing strategies are easier than HR influencers. Can someone affirm me? Or someone disagree with me? Let's talk about it. I want to talk about it in the chat. I want to start some discussion about that. My nose is still so itchy. I'm so sorry. I can never let myself rewatch this video because I'm literally just scratching my nose the whole video. I don't know what's going on. But we chose government because government is one of the harder ones where a lot of students are losing marks. But on top of that, it's also one of the Learn Twos. So one of the Learn Twos is analyze the influences of government and the global market on financial management. So the big one you guys need to know for government and for finance is ASIC. So ASIC is the Australian Securities and Investment Commission. Let me just tell you now, ASIC and ACCC always get confused, always. ACCC is always going to come up in marketing because it's got to do with fairness in trading and in the market, while ASIC is always got to do with finance. So a lot of the times in finance multiple choice questions, they'll give you ASIC, they'll give you the ACCC as an option, but it's not that. A lot of the times when they bring up different statutory commissions and different bodies, your answer is going to be ASIC. So it's an independent statutory commission who is accountable to the Commonwealth Parliament. They enforce and administer the Corporations Act of 2001 whilst protecting consumers and investors in areas such as investment, life insurance, banking, superannuation, and general insurance in Australia. I really swear you need to know this. So that what they are, so they're an independent statutory commission who's accountable to the Commonwealth Parliament, but also that they're enforcing and administering the Corporations Act of 2001. I cannot tell you how many short answers have asked about this point because again it's from a Learn To, so they're really focusing on assessing that in trials and in HSC, but also just in the multiple choice it will ask like what law is ASIC enforcing, and they'll have all these different laws. If you can just connect it to the Corporations Act and you know that, I really recommend that. And also knowing that their aim is to reduce fraud and unfair practices in financial markets is very important. Honestly, this whole slide, these 3 points I think are the most important. And if you have that as a base understanding and that's all you know about ASIC, I think it'll still take you far. I think it will still take you far. They collect information about the companies, such as the financial information that companies must disclose in their annual report. If any business is found to be in breach of these laws, ASIC will investigate the matter and determine an appropriate remedy, whether that's civil or criminal. And then failure to comply with ASIC's rules and guidelines will lead to a deterioration in the business's reputation and trust. So these are just some general points about ASIC. It's very big to do with protection from fraud and unfair practices. And then again, with like even with the deterioration, if they're not complying with ASIC's rules, ASIC goes and exposes them, and that's when you'll see businesses on the news that like the ASIC has like exposed. That deteriorates their reputation and trust. That deterioration of reputation and trust leads to reduced sales. Because if I saw a business that was like it's like involved in like a lot of fraud or like embezzling money, or like financially was really unfair in their practices, you're not going to want to support them. And a lot of it's kind of like cancel culture. It's like cancel that business. We don't support. So that's why ASIC's really important in the work that they're doing. Is really important. Then there's company taxation. I'm so sorry. I promise these are like honestly all of like I'm not even gonna lie, I really wasn't a fan of many of the influences of finance just because you know what's also and sorry, I've just got the syllabus up next to me. The banks, unit trust, finance companies, superannuation funds, Australian Securities Exchange, investment banks, and life insurance, that buff sale, however you guys say it. Nah. I really hope that some of you guys have done finance and this isn't your introduction. This isn't for everyone an introduction to it. If you've done finance, you know what I'm talking about. The influences are just not pretty. The influences are not pretty. The influences were not making me love business studies too much. But this is company taxation. So all incorporated Australian businesses are required to pay company tax on their profits earned in the financial year. And company tax is a proportional tax. It's levied at 30% of the company's net profits and is paid before profits are distributed as dividends. Any increase in company tax drives up the price of goods and services, which then decreases the consumer demand because it's more expensive. And then that's decreasing their overall profitability. Okay, I'm just trying to see if there's anything else. I'm just looking at the syllabus. Is there anything else I wanted to say about company taxation? It's an essential source of funding for the government because it allows them to provide essential resources and services like healthcare. But businesses need to make sure that their financial records are up to date with that, and that they're not overstating their taxes either. The final influence that we're going to look at, and again, it's from the Learn 2, so gotta come up. This Learn 2 is the influences of government and the global market on financial management. I really want to focus on global financial management in this lecture because I remember when I was in school, it was something we just briefly touched over, and even my students that I tutor for business studies now, no one really feels confident with global market strategies, and I hope that some of you do. I don't want that to be a generalization, but even when I was doing it, I was just kind of like, oh, I'll focus on the other strategies, like it's not even in Australia, like what's the chance it comes up? It'll come up. It comes up, especially when you're dealing with outsourcing, and much of the time it can be connected with operations and global outsourcing. We don't want to risk it. So let's talk about it. It's actually not too bad. I think the influences, I think when you get to the strategies that it gets a little bit harder. So global economic outlook refers specifically to the projected changes to the levels of economic growth throughout the world. So if it's a positive outlook, the gross world product is projected to increase, which impacts the financial decisions of a business. And as a result of a positive outlook, there's an increasing demand for goods and services, which requires businesses to increase their production. But by increasing that production, the financial managers need to purchase additional equipment and employ extra staff, which means that costs may rise. On the other hand, poor economic conditions may adversely impact financial managers as a global economic downturn reduces consumption, investment, and consumer confidence, which then hinders their profitability and solvency. So let me explain it in a simple light. Positive outlook, I like to think of it like rainbow and sunshine for businesses and for everyone. Everyone's happy. Basically, the economy is looking good. Everyone's happy. A lot of people are working. There's high employment rates because they're working and people have more disposable income. They're going out and they're spending money. Everyone's like, let me buy whatever I want. Everyone's making money. Everyone's happy. Everyone's working because they're spending money. Businesses are making money. And because there's high demand from how many people are spending, businesses are required to make more and produce more, which is just increasing demand. Of course, they've got to meet that with supply. So there's an increased cost for businesses, but that's rewarded with increased profitability. And all of that is helping. And then there's more jobs and they have to create more jobs and pay for more services, which is just creating more payment. And then altogether, the economy is just booming. It's basically just an economic boom. Everyone's happy, super positive outlook, rainbow sunshines. We love money. The negative economic outlook and a poor economic outlook is the complete opposite. Low unemployment rate. Because people aren't working, they're hesitant to spend their income. Because people aren't spending their income, goods and services aren't selling, which is reducing jobs even further because there isn't demand. Then it's limiting the need for supply, which is also reducing costs. It's reducing costs, it's reducing the need for labor, which is then in turn reducing the employment rate. And then businesses and also banks don't really feel confident giving out loans because they know that we're in like a negative economic outlook and the economy is kind of in a downturn. While in the positive outlook, banks are like, you know what, have this money, like we trust you, like everyone's spending, take it. It's basically just the way I memorize it, and the way that helps me is just understanding positive outlook. Everybody's literally happy, economy's happy, businesses are happy, consumers are happy, workers are happy, government's happy. Complete opposite. It's like two ends of the spectrum, and it's like super happy and then depressive state of the economy because it's global economic downturn. Okay, that's global economic outlook. For me, I had to memorize it that way, and for some of the topics, if I didn't, I don't want to say dumb it down and like discredit myself, but if I didn't make it as simple as possible for myself, there was no way I was going to understand it. And I have no shame in saying that. I don't want you guys to think, and I really wish that I wasn't as hard on myself as I was when I was in year 12. But sometimes I'd be dumbing stuff down and I'd be like, man, I'm so dumb that I like had to do this, like as if like students that are doing well did it. And like I still got the marks, and that's not me being like, yeah, guys, like I got a band 6 in business, but I didn't even study, or like I studied in this like super dumb way. It's not even to flex. It's more just to validate any of you guys that are going through it. Do what works for you. There's no shame. Like I'm not embarrassed admitting that now, but at the time when I was doing it, I was like, this is so embarrassing that I have to imagine positive economic outlook as a rainbow. I was like, what is wrong with you? Like that is so embarrassing. I would not admit that to anyone. But now that I got my 95 in business, and I remember writing about that in my trials, I was like, you know what? That that was smart. That was smart, and that helped me, so it's validated. So yeah. That's my rant. I'm very big. Clearly, I hope you guys can see I'm very big on this whole picture of what you're supposed to look like compared to what you're actually doing. Do what works for you. It worked for me, got me the marks I needed. So don't feel embarrassed if you have to dumb things down in business. There's no shame in that. There's so much content. A lot of it's really hard, especially all this finance stuff. For me, I was not a math student. It didn't matter if I was doing really well in English and all that. None of that mattered. I was not a math student. A lot of this was not clicking, and in operations as well. My brain just wasn't. I don't really think it was wired in that way. I was very much like an English history student in year 12. So these topics just weren't. Business wasn't businessing. Like it just was not connecting. I couldn't connect the dots. So unless I found ways that were working for me, and you'll see it later when I get to some other topics, there was no way I was going to get through them. So yeah, I recommend simplifying it as much as possible for yourself and feel no shame in it. YOLO, live, laugh, love. Let's keep moving. For availability of funds, it's the ease which a business can access funds for borrowing on the international market. And that comprises of various institutions who lend money to individuals or companies seeking to raise capital. But there's obviously various conditions and rates that occur. And they're primarily based on risk, demand, and supply in the domestic economic conditions. So, for example, the economic downturn of the global financial crisis in 2008 to 2009, scratch your nose one more time, I'm so sorry, had a critical impact on the availability of funds for companies, which led to a sharp rise in interest rates because there was such a high level of risk in lending. And then that availability of funds also affects businesses' financial management because it affects whether or not they're going to obtain adequate funds to then successfully expand, which is then affecting their growth, which, not to say I told you so, but everything in financial objectives links to one another. The final one is interest rates, and this comes up again in global market strategies. Interest rates are the cost of borrowing money, but the higher level of risk involved in lending to a business, the higher the interest rates. So with Australian interest rates generally being higher than developing companies, Australian businesses a lot of the time are tempted to be like, you know what? Why would I pay interest rates here when they're higher than developing countries across the world, when I could just go there and take advantage of the cheaper and lower interest rates? But they don't realize a lot of the time that they're proposing themselves to risk because as a business, they're susceptible to exchange rate movements. Just because it's cheaper now doesn't mean it's going to be cheaper in 5 months' time or in 6 months' time when that whole contract is sorted and confirmed. So a lot of the time businesses are like, you know what, we're just going to go to this country, we're going to go to this developing country, we're going to take advantage of how cheap their exchange rate is, how cheap their interest rate is, and like get our bonus. But it doesn't always work like that, and it is risky. So here is a case study. So for finance, for economic outlook before 2009, they were benefiting from the impacts of globalization because obviously that was increasing their demand for services, and it was reflective of their all-time high net profit of $970 million. But then after that, everything comes to a crash. So they went from this positive global economic outlook to a negative, where they experienced a rapid decrease in their international revenue by 88%. And as a result, people stopped traveling and corporate travel was cut. So that just shows how, like, that's what I mean. Like, it's two sides, and it's like rainbow, sunshine, happiness, $970 million profit, and then 88% decrease in revenue before and after. That's why it worked for me. Availability of funds. So since the global financial crisis, the supply of funds has been lower in Australia and overseas Qantas due to the closure of many financial institutions. And a lot of global financial institutions were also implementing stricter lending criteria. So Qantas was assessed to be riskier because they had reduced profits in 2014. And again, when lenders are looking at, do we trust this business? They're looking at the profits they're making. And if their profits haven't been too high, they're not essentially going to trust to lend you as much as you might want. And for interest rates, Qantas is exposed to movements in interest rates in Australia and overseas. As interest rates increase, so do the interest repayments Qantas pays. Qantas has shifted most of its operations overseas and is more cost effective to fund them from an overseas bank due to lower interest rates. But in saying that, if those exchange rates do increase, so the interest rates, they're lost. Okay, let's do it. Which organization ensures that Barb's Batteries Pty Ltd operates in a financially responsible manner? Which one, guys? Which one? There's only one right answer. There's only one right answer. I'm gonna give you guys a couple seconds. You guys can leave that in the chat and I'll let you know if that's right. Okay. Yay. Process. Yay. Okay. Oh, my nose. My nose. This is really embarrassing. I'm so sorry. Please forgive me. Okay, let's look at financial needs and planning and implementing. I always ignored this when I was doing year 12. When I was studying business in year 12. I don't know if you guys are the same, but when I was doing business, like when I thought of processes, I was like ratios. I was like, I need to do the ratios. I literally forgot that any other point existed. I was like, it's just the ratios. No, it's not. No, it's not. And then I'd get questions on this and I'd be like, I don't actually know anything. So I still sometimes forget that this comes up in processes because I feel like there's such a focus on the ratios, but this is how they can trick you. So the financial needs of a business are determined by the size of the business, the phase that it's in, the future plans for growth and development, and the capacity to source finance. So depending on that business plan, financial management has to set out the finance required, how they're going to source that, and then display their range of financial statements. But that financial statements also need to show that the business can generate a return on the investment. That's why they then use budgets, which provide information in quantitative terms about requirements to achieve a particular purpose. Budgets can show the cash required for planned expenditure, the cost of capital expenditure, the estimated use and cost of raw materials or inventory, and the number and cost of labor hours required for production. The budgets are just kind of showing all that planned expenditure, and then they can then use that for planning and implementing cuts and then applying strategies from there. Budgets also provide financial information on a business's specific goals and are used in operational, tactical, and strategic planning. Like we said, operational is day-to-day goals, tactical is 1 to 2 year goals, and strategic planning is 5+ year planning. They enable a constant monitoring of objectives and provide a basis for administrative control of expenses, and production planning. They also allow for the comparison of planned performance against actual performance to determine whether corrective action needs to be taken. So, then we get into record systems, which are the mechanisms employed by a business to ensure that data is recorded and the information provided is accurate, reliable, efficient, and accessible. A critical process in maintaining record systems is to minimize the amount of errors in the recording process to ensure financial managers produce accurate and reliable financial statements. I feel like record systems, the most important thing is kind of this point where it's like, let's minimize the amount of errors so that our reports are as accurate and reliable as possible. And to do that, they can use the double entry system of accounting, which acts as an important control mechanism, and it balances the entries and finds errors between them, just so you're not admitting systems that and accounting statements that have errors in them. But in that, financial risk comes. So financial risks are the risk to the business being unable to cover its financial obligations. So if the businesses aren't able to meet their financial obligations, they face the possibility of becoming bankrupt or insolvent. And then that's an added risk for businesses if they finance the operation from external debt instruments, because then they're getting chased up on all that money externally. So to minimize financial risks, businesses must consider the amount of profit that needs to be generated and then make sure that they're covering the cost of that debt as well as making a profit. It's great to make a profit, but if that profit and all it's doing is covering you the cost of your debt, you're literally at zero. It's like covering that debt and then still making profit on top of that.